Hello, everyone. So welcome to the stream today. Very much excited for having you to join the stream once again. Today we continue with our discussion and we're looking at some exam steps and looking at a practical question on some accounting standards like IAS 16, IFRS 9, IAS 32, IAS 37. In relation to that. So if you join the stream, comment in the chat box with any questions that you have. We are looking at the ICA November mock egg questions. Okay, not the exam, so the mock questions. So you can download it. We are looking at the question 2 of that trial question sent out by the ICA. That's what we're looking at. So you can download it on the ICA website, or if you want to, you can send us hi and it will be sent to you as well on WhatsApp on our line 0501149296. Patience, I see you. Good evening. I believe you are doing well. Andrew Opon-Beko, I see you. You are welcome. Isaac Idwam, I see you. Good evening. I hope you are doing well. If you join the stream, give us a thumbs up on the video. That way we get more engagement on the video. The question we are looking at today is the ICA November mock questions. ICA November mock questions. The question 2 to be specific. We are going to be looking at some 5 accounting standards, very critical accounting standards in this question, and explain the principles, the concepts in order for you to prepare well for the examination in relation to that. M. Seidu, hello, I see you. You are welcome to the stream. When you join, give us a thumbs up on the video for more engagement on our video, so YouTube can push it so we get more engagement in relation to that. So let's get into it. In that case, you can see the first question displayed on your screen, and this is based on IAS 16. And let's look at how we can do the various computations in relation to that. Richard Amegashi, I see you. You are requesting or asking of the WhatsApp number. It's 050-114-9296. 050-114-9296. Samuel Quasin, hello, I see you. You are welcome to the stream. I believe you guys are doing well. So the WhatsApp line is 050-114-9296. We are looking at the ICA November 2019 mock questions, financial reporting. We are looking at a question 2. It has 5 accounting standards there that I want to take you through, so you know how to do the various treatments. Grace, I see you. You are welcome. Good evening. I hope you are doing well. Okay. So the first question is displayed on the screen, and let's look at it real quick. Like I mentioned, it is based on IAS 16. Usually you know about IAS 16, property, plant, and equipment. And about property, plant, and equipment, when you pick every standard or any standard, we're looking at the recognition criteria, the measurement basis, and then the disclosure requirement. The question is basically the requirement there is that we should, or what is the charge for depreciation of plants and machinery for the year ended 30th June 2015. So that is the requirement of the question. We are supposed to compute the depreciation in relation to that. So what do we do here? Let's look at the question. The plant and machinery account for a company for the year ended 30th June 2015, it's as follows. So plant and machinery accounts have been given. Now on the debit side, we see balance coming down there on 1st July 2004. That is 960,000 Ghana cedis. Then on 31st December 2004, there was a purchases of machine of $200,000. On the credit side, we see that there is transfer to disposal accounts on 31st March 2015. On 31st March 2015. So if there is transfer to the disposal account on 31st March 2015, the question we ask ourselves is, that means that asset is going to be sold. So we would have to compute the depreciation for that asset that has been transferred to the disposal account in relation to that. Then at the end, 30th June 2015, we see that the carrying amount of the asset is 1,080,000 Ghana cedis in relation to that. Ebenezer Arthur, I see you. You are welcome. When you join the stream, please give us a thumbs up on the video in relation to that. I mentioned that the question we are solving is the ICA November mock examination question, November 2019 mock examination question. You can download it on the ICA website. We are looking at a question 2 on it, or you can send us a message on WhatsApp and it could be emailed to you. Sorry, WhatsApp or sent to you on WhatsApp in relation to that. So what do we do here? Let's break down the question. Nana Apia Kubi said, thanks a lot. Today is my first time on this platform. Much appreciated. That is great to hear, Nana Apia. And I hope that you find a lot of useful materials and videos here to assist you to be able to become successful in your endeavor. So the company's policy is to charge depreciation on plant and machinery at 25% each year on the straight line basis with appropriate charges in the year of acquisition and the year of disposal. So the year that we acquire the asset and the year that we dispose the asset, there will be depreciation to be charged on the asset in relation to that we need to take care of or look out for in relation to that. So the day we acquire the asset or the year we acquire the asset, we are going to be charging depreciation. But remember, it is on proportionate basis. It means full year depreciation will not be charged, but will be based on proportion in relation to that. So how do we go about this question? Number one, we see that at the beginning of the year, the year is ending on 30th June. So it means the year starts on 1st July, all right? So if the year starts on 1st July, it means at the beginning of 1st July, this is the value of the asset, 960,000 Ghana cedis. Then on 31st March 2015, there was a transfer to the disposal account. So we need to ask ourselves, how long were we having the asset and then to the time that the disposal was made of the 80,000? So if you check from 1st July to the 31st March, that is going to be about 9 months in relation to that. So keep these figures, and then I'm going to be going forward to find out how we can do the computation in relation to that. So we are having 960 at the beginning. We are having a disposal of 80,000, and then there is a purchases of 200,000. These are the three figures we are interested in. But most importantly, look at the years. Okay, the period is very important. We have 1st July, we have 31st March 2015, and we have 31st December 2014 in relation to that. And remember, the depreciation is also 25% in that case. So let's find out how we can solve this question and calculate the depreciation that will be charged for the year. Now, you may see my background a bit going on and off. I don't know, our current here is just jumping on and off like that. Don't know if because it's raining at Ghana's problem. Cletus, I see you. You are welcome to the stream. So let's look at how we solve the question. So depreciation charge. So if we are looking at the depreciation charge, what do we do? Remember, our year ended is very, very important, and that is 30th June 2015. That's where we are at. So if the year ended is 30th June 2015, we need to calculate the depreciation. First, we need to look at the depreciation on the asset that was disposed. So the asset disposal had a cost of 80,000, and our depreciation rate is 25%. Now remember, the year starts on 1st July, and then the disposal was being made on 31st March 2015. So if you look at 1st July 2014 to 31st March 2015, that is going to be a 9-month period. So our depreciation is going to be times 9/12. I hope you are getting the concept. So this is how we compute the depreciation on the assets that has been disposed of during the year. So we do the arithmetic on that, and that should give us 15,000. So that is the value for the asset depreciation for the asset that has been disposed of. Then let's look at the other assets that were held, that were not disposed of. So remember, the total asset we had during the year was 960, or at the beginning of the year was 960,000. Now we've sold 80,000 off. So we're going to be taking that out. So once we take that out, what are we going to get? 960 minus 80. That's going to give us 880. So on that 880, we calculate depreciation at 25%. Now remember, the other assets were not disposed of, so they are still there. So we will charge depreciation for the whole year, and that is going to be 220. I hope it makes sense. So the 960 was the total assets at the beginning of the year. We sold 80,000 out. So we need to take, that is why we calculated the depreciation on the 80,000. And then we look at the other assets that were at the beginning of the year. Then during the year, we were told that the company also acquired a machine. So machine acquired, we were told that was 200,000. So it was acquired, very, very important. Let me look at that. It was acquired on 31st December 2014. So if you check from 31st December 2014 up to 30th June 2015, that is going to be how many months? 6 months. So we're going to still have 25% times 6/12. I believe you get in the picture. Because the asset that was acquired on 31st December 2014 up to the year ended 30th June 2015, it means it is 6 months. So that's going to be 6 months. And when we do the computation for that, that is going to be 25,000. So we add it up, and that gives us the total depreciation charge. And that is going to be 260,000. So this is the answer to the first question on the A aspect of the question 2 that we are looking at. I believe you understand the concepts there. Very simple, sweet, straight to the point. If you have any questions about this, please put it in the chat box for me. If you have any questions, put it in the chat box for me. So this is based on IAS 16, and the question was put, we were presented with the issue in relation to the plant and machinery accounts, and we had the balance at the beginning of the year. We had a disposal during the year, and we had some acquisitions during the year, and the examiner is asking us to compute the total depreciation charge. So this 260,000 Ghana cedis, or $216,000, depending on where you are standing, we will take that to the income statement for the year under consideration. So any questions? Are we all okay on this one? So that we can go to the B aspect of the question, and that is going to be on IAS 23, I guess, borrowing costs. I believe it is clear. So let's go there. I'm seeing a comment from Moses Kwam. Please, which level is this? We are looking at accounting standards, and so it cuts across level 2, financial reporting, level 3, corporate reporting. But the question I'm solving is the financial reporting ICA November 2019 mock questions. M. Seidu said, none of the assets held at was more than 3 years. Please explain this clause. Okay, so we were told in the question that none of the assets held at 1st July 20X4 was more than 3 years old. Usually, this statement simply refers to the asset that were at the beginning of the year. You know, at the beginning of the year, we had 960,000 assets, and it is telling that these assets have not been there for more than 3 years. So at most, the assets you are seeing there are going to be 3 years at most, or less than 3 years in relation to that. But the reason why we are not even interested in that statement and we didn't use it in anywhere is that that would have applied if we were using the reducing balance method and the asset account was prepared, taking into consideration depreciation. As you can see, this asset account was prepared at a cost module. So everything in the thing is a cost. And so we don't consider that statement. But what that statement simply means that all that the assets we are having or we were having at the beginning of the year does not or are not more than 3 years old. So M. Seidu, that is the answer to your question. So let's look at the B aspect of the question. And the B aspect of the question, it's about borrowing cost, IAS 23. If you have any questions, please put it in the chat for me. And if you join the stream, do me a favor with a thumbs up on the video. That way we get more engagement and YouTube will be able to push the video so we can reach as much people as possible in relation to that. M. Seidu says, thanks, you are welcome, Seidu. Now, let's look at the requirements of this question first, even before we come to the question itself. So for 5 marks, again, the examiner is asking us, state the IAS 23 rules on the capitalization of borrowing costs. 1, calculate the cost of the asset on the initial recognition. 2, and explain the amount of borrowing costs capitalized. So you got to understand what's happening in this question. So for 5 marks, the examiner is requesting you to do 3 key things. Tell us about the rules on the capitalization on borrowing cost, calculate the borrowing cost of the assets that we need to, or calculate the cost of the assets at the initial recognition, and then 3, explain the amount of borrowing cost to be capitalized in relation to that. Why am I emphasizing on the requirements like that? Because many a times students just read and then they calculate and they go away. But the question is in 3 folds. It means you must answer the question in that fold in that case. So first, you tell us about the rules about IAS 23 and the capitalization of borrowing cost. And then 2, you calculate the initial cost of the asset. And then 3, you look at the amount of the borrowing cost that you are capitalizing in relation to that. Augustine, hello. I see you. You are welcome. I believe you're doing well. So let's now go to the question. Rooney Limited has recently finished building a new item of plant for its own use. The item is a press for use in the manufacture of industrial diamonds. Rooney Limited commenced construction of the assets on 1st April 2020 and completed on 1st April 2012 and completed it on 1st April 2014. So we got to understand what's happening here, especially this paragraph. It's something we'll be interested in. So they started the construction of the asset on 1st April 2012, and then they completed on 1st April 2014, meaning that they took 2 years to actually construct the plant in relation to that, or yes, build a plant in relation to that. Now look at what's happening here. 1st January 2012, Rooney Limited took out a loan to finance the construction of the assets. So they started construction on 1st April 2012, but they took the loan on 1st January 2012. You've got to be careful. I'm emphasizing here because of the capitalization period, so you understand how we're going to be going through that. The interest is charged on the loan at a rate of 5% per annum. The annual interest must be paid in 4 equal installments at the end of each quarter. Rooney capitalizes interest on manufactured assets in accordance with the rules in IAS 23 borrowing costs. The cost, excluding finance costs of the manufacturing the assets, were 28 million Ghana cedis. So this is the cost of the assets, 28 million Ghana cedis. And we are told they took a loan for it. So before we go through, there are 2 things we need, or 3 things we need to focus on. 3 things. 1, the period of the acquisition, the capitalization. They started on 1st April 2012, ended on 1st April 2014. That is a full 2 years. So because in this question, there was no haltage, there was no stoppage of the product, it means that interest expenses for the 2 years period must be capitalized in accordance with IAS 23 in relation to that. So before I go there, let's even talk about the rules about capitalization of borrowing costs in accordance with IAS 23. Now, IAS 23 simply states that, among other things, borrowing cost refers to interest expense and other costs incurred in the arrangement of funds. Now, usually the interest expenses are required to be expensed. However, if the entity borrowed the money for the construction or acquisition of qualifying assets, then the standard states that it has to be, the interest expenses must be capitalized. So what is a qualifying asset? A qualifying asset is an asset that takes substantial time to be ready for use. So if we look at this, you realize that it took 2 years. It means it's a qualifying asset. It stands to mean that, yes, the interest expenses incurred during the capitalization period, that is the start of the contract and then the end of the contract, has to be capitalized and added to the cost of the assets in relation to that. However, all other interest expenses incurred will have to be written off in the year as expenses or as part of the finance cost for the organization for the year ended under consideration in relation to that. So that is the first aspect of the question, stating the rules on the capitalization. Finance costs or borrowing costs, interest expenses traditionally are supposed to be expense. However, if the funds are for the construction or acquisition of a qualifying expenses, or the borrowing cost should be capitalized. And that is very important. That is very critical for you to understand in relation to that. So having that in mind about the principle of the computation, let's now look at the computation itself. Now, how much did you think they went for from the bank? How much do you think they went for? Certainly the cost of the loan, which is 28 million Ghana cedis. The cost of the machine, sorry, 28 million Ghana cedis. So they borrowed 28 million Ghana cedis. We are interested in the amount to be capitalized. So, and that is going to be a 2 years period in relation to that for us to calculate the initial cost in that case. So take care of the 28 million, and the interest rate is 5% per annum, and our capitalization period is 2 years. Okay. So let's look at how we compute and then put the pieces together in relation to that. So to get the initial cost of the assets, that is going to be, we're working in Ghana cedis, right? So we put our Ghana cedi up, then we bring the cost of manufacturing, and that was giving us 28,000 or 28 million. Then we bring the interest expense to be capitalized. So interest capitalized. And that is going to be the 28 million we borrowed times 5% per annum times 2 years. Does it make sense? And that is going to give us 2,800. 0.05 by 28,000 times 2, so 2,800. So we add it up, and that becomes the initial cost of the asset. And what would the initial cost of the asset be? The initial cost of the asset, when we add the two, will become 30,800. So that is the answer to the question 2 in relation to that. Sweet, simple, straight to the point. Sweet, simple, straight to the point. Any questions, please put it in the chat box for me. MCA said, oh, I'm late today. Yeah, you are late. But don't worry, you still can watch the playback as we continue with the discussion in relation to that. So any questions? I hope it is clear. This was on IAS 23. Remember the principle, okay? Remember the principle, the rules. I explained that earlier, and then we look at the capitalization. So take note, even though the loan was taken on 1st January 2012, work started on 1st April 2012. So capitalization will begin on 1st April. So somebody may ask, okay, Nhyira, the interest expenses from January to the March, how do we treat it? It will be expense in the income statement because work has not begun, and so we cannot capitalize that part. So the January 2012 to 31st March 2012 will be will be written off in relation to that. So that is how we deal with this question, borrowing costs. Any questions for me? Or everybody okay so far? Again, for those of you who are just joining, we are solving the ICA November 2019 financial reporting mock question 2. And it has 5 key accounting standards in there. That is why I'm picking it up. We've looked at the first one that was on IAS 16, property, plant, and equipment. And then the second one, which is the B, is on IAS 23, borrowing cost. And we just finished looking at that. So let's go to the C, and the C is on provisions. IAS 37, provisions, contingent assets, and contingent liabilities. And I want you to pay close attention to this question because it has a twist to it that you must make sure you pay close attention to. So let's go to the C aspect of the question. Again, this is a 5-mark question, and the examiner says, explain the correct accounting treatment for the above with calculations if appropriate. With calculation if appropriate. What it means is that you're going to be writing some English and then do some computation as well. Okay, if you ignore the English aspect, you'll be in trouble. And you do just the calculation, you'll be in trouble in relation to that. So you got to write the English and then you also do the calculation if you need to do it. Now, this is based on IAS 37, provisions, contingent assets, and contingent liabilities. Now, before we go through the question, let me just give you a gist about the provisions, contingent assets, and contingent liabilities. When it comes to provisions, we said that provisions can be defined as a liability of uncertain amount and timing. Okay, so it is a liability, something we gotta pay, but we don't know when we're gonna be paying it, and we don't even know the amounts to be paid in relation to that. So provision is a liability of uncertain amounts and timing, whilst liability is simply a present obligation as a result of past events, the settlement of which results into an outflow of the economic benefit embodying the entity. So that is also about liability. Now, according to IAS 37, provisions, contingent asset, contingent liability, what is the recognition criteria? The recognition criteria is ROT, that is ROT. It means if it is rotten, you provide for it. Now, what is the meaning of ROT? ROT simply means that R stands for reliably estimation of the cost, okay? O means there has to be a present obligation. Please note, the present obligation can be contractual or can be legal. Now, legal is where you sign a contract, you sign an agreement. Contractual, it's because of your behavior in the past or the message that you have passed across to your customers, to your stakeholders, or publications on your website. So the present obligation can be created by legal agreements with customers, with governments, or with other stakeholders, which creates the present obligation or what you have done in the past in relation to that. And then the T is that the settlement definitely will result into a transfer of the economic benefits embodying the entity. As I say all the time, when you are determining whether something qualifies as a provision and has to be recognized, the O is very important. You must ask yourself, is there a present obligation? And that present obligation can be, like I mentioned, legal by an agreement or constructive in relation to that. Now, where there is that present obligation and we need to make some payments in the future, normally about decommissioning cost or environmental cost or restoration cost, what happens is that we discount that amount into the present term. Okay, we discount that amount into the present terms. Now, when we discount it into the present term, we're going to be using the current borrowing cost or the cost of capital of the organization in relation to that. And so that will help us to discount it into present terms. And the initial recognition is going to be that we debit our property, plant, and equipment if it relates to a specific asset, and then we credit the provision in that case. On subsequent measurements, now the asset will be depreciated over the economic useful life, and then the provisions will be unwounded. So there will be unwounding and annual charge of the provisions, which will be debited to the income statement and credited to the provisions in the statement of financial position. So basically, this is what you have to understand when we talk about the issue in relation to IAS 37. So arming yourself with this understanding and having this quick revision on IAS 37 provisions contingent assets and contingent liabilities. Let's look at the question and then do that. So the following, let's scroll down. Okay, I guess we're okay. The following information relates to the financial statements of Nhyira Limited for the year ended 31st March 2014. Remember, the year ended is very important, and the year, the period, all of these things are very important when we are doing our computation in relation to that. So the following information relates to the financial statement of Nhyira Limited for the year to 31st March 2014. The mining division of Nhyira Limited has a 3-year operating license from an overseas government. This allows it to mine and extract copper from a particular site. When the license began on 1st April 2013, Nhyira Limited started to build on the site. The cost of the construction was 500,000 Ghana cedis. So let me build up to this point. You must understand what's happening here. So it's a mining company, and they have acquired a mining license to operate for 3 years. For that reason, on 1st April 2013, which was the beginning of the current year under consideration. Remember, the current year ended its 31st March 2014, which means at the beginning of the current year, which is 1st April 2013, they started the construction. They started building on this site where they have acquired the license for mining. And we are told that the cost of this is going to be $500,000. Now, assuming there was nothing else, then the cost of this building will be depreciated over the economic useful life or, of 3 years, which is the operating license life. So assuming there was nothing else, we would depreciate the building over the life of the license term in relation to that, which is going to be 3 years. So that in that case, our annual depreciation will be 500,000 Ghana cedis divided by 3. And that will be something like 167,000 Ghana cedis in relation to that. That will be every year. But there is an additional information, so we won't go that route. I am telling you this because the examiner could mention that do the computation without the provision and then do it with a provision. So you must understand, assuming the license was not there, assuming there is no decommissioning, assuming there was no restoration, how the treatment would have been in relation to that. Let's look at the additional information there. The overseas country has no particular environmental decommissioning laws. In its past financial statement, Nhyira Limited has given information about the company's environmental policy and has provided examples to demonstrate that it is a responsible company that believes in restoring mining sites at the end of the extraction period. So look at what's happening here. Remember, the country that they got their 3-year license from, they don't have any laws on decommissioning. It means left for the government alone. If you're a mining company, you can finish mining and then go away. The way the land is discarded, whatever it is, they don't care. There's no law attached to it. But this company has proven in the past that it is an environmentally responsible company, and they believe that after every extraction period, the site must be restored. It's very important for you to understand these two extremes, because remember we said for a provision to be recognized, there must be what? A present obligation. And the present obligation we mentioned could be contractual, which is the past behavior, the expectations that the entity has created in the eyes of stakeholders, or legal agreements in that case. But in this case, since there is no law, they are not bound to do it. So they are doing it because it is their policy. So there is a present obligation by virtue of the contractual obligations created, the expectation that they have created for all of their stakeholders in relation to that. The cost of removing the construction at the end of the 3 years is estimated to be 100,000 Ghana cedis. Okay, so at the end of the 3 years, the cost of decommissioning, removing and restoring the site is going to be 100,000 Ghana cedis. What did I tell you? We discount that into present terms, and then we take it there in relation to that. The cost of the site currently shown in the trial balance is 500,000 Ghana cedis, meaning that the cost of the site does not include the provision component. But according to IAS 16, the initial cost of the asset shall be the purchases cost and any other cost incurred in bringing the assets to its present use, including provisions for decommissioning or restoration. So we must add the restoration or decommissioning to the cost of the asset in the books of the organization in relation to that. The company has a cost of borrowing of 10%. Good news. And then again, explain the correct accounting treatment for the above. And I've spoken about the theory aspects already. So what are we interested in here? The cost of the building is 500,000. The cost of restoration is 100,000. And we are going to be discounting this 100,000 into present terms at 3 years using the current cost of borrowing of 10%. I hope you are getting the idea in relation to that. So that is the three things, or these are the three things we are interested in. So what do? Let's first, now there is a present obligation. I've mentioned it because of the expectation that they have created and the organization's policy. So there is an obligation. Hence, we must provide for this 100,000 in the books of Nhyira Limited. So let's close it up. And let's see how we present. So the first thing is the present value of the decommissioning cost, DC for decommissioning cost. And that's going to be 100,000 times 1 over 1.1 exponent 3. Okay. 1.1 because the cost of borrowing or the cost of capital of the company is 10%. Exponent 3 because the license is 3 years, and after it's at the 3 years that we are going to be decommissioning it in that case. So when we do the computation, that is going to give us 75,131. So that's the present value. So what is the double entry for this present value? The double entry for this present value is to debit the property, plant, and equipment, and then we credit the provision. That is the initial recognition. So on the initial recognition, you could bring the cost of the building, and that's 500,000. And then we bring the decommissioning cost, and that's 75,131. So we add the two up, and that gives us 575,131. So that becomes the initial cost of the property, plant, and equipment. I hope it makes sense. Very simple, sweet, straight to the point in relation to that. So this is the initial recognition. Remember I said we debit the PPE. That is why we are adding it to the PPE. Then we credit the provision in relation to that. So that is the initial recognition in that case. Any questions for me, please? If you joined the stream, give us a thumbs up on the video. That way we get more engagement on the video, and the YouTube will be able to push the video so we can reach as much people as possible and grow the channel together and be able to meet the need of other students as well in relation to that. Any questions? I hope you are okay with the computation in that case. So that is the initial recognition. Remember, the requirements of the question was to tell us to explain the correct accounting treatment for the above. So that is the initial recognition there. Now, on subsequent measurements, like I mentioned, the PPE will now be depreciated. That is the 575,131 will be depreciated over the 3 years period. Then the present value we had here, 71,131, there will be unwound or unwinding, and then we will make an annual charge of that. Will be debited to the PPE, and then will be credited to the property plant and credited to the provisions account in relation to that. What it means is that on subsequent measurement, the PPE will be reducing because it will be the depreciation minus the initial cost, and then your provision will be increasing because the unwinding will be added to the provision, so that we build up that reserve. At the end of the third year, we will be able to get our 100,000 Ghana cedis and put it down and use it for the decommissioning. So this is what you have to understand when we talk about provisions and about this question. Any questions for me, or we good? Everybody good? So let's go to the next question. Richard Amegashi, I see you. You are welcome to the stream. Give us a thumbs up on the video page. That way we get more engagement. Thank you for all those who have given us a thumbs up on the video so far. If you're watching, you've not, come on now, give us a thumbs up. And in case you've not subscribed to the channel, I don't know why you are not part of the Nhyira Premium family. So click on the subscription button and become a VIP member. That way you'll be the first person to be notified should we release any content. Now, for those of you who are just joining, we are looking at accounting standards. We've looked at IAS 16. We've considered IAS 23, borrowing costs, and we just ended on IAS 37, provisions, contingent liabilities, and contingent assets. And we are solving the ICA November 2019 financial reporting mock question 2. And that is what we've been covering so far. So let's move on to the next one. And that's going to be the D aspect of the question. And I love the D aspect of the question because I love the D aspect of the question because it is on financial instruments. That is one IFRS 9 financial instruments in relation to that. Now, IAS 32, it's financial instruments, disclosures, and presentation. Whilst IFRS 9 is still financial instruments, but the IFRS 9 is replacing IAS 32, financial instruments, recognition, and measurement. All right. So if we are talking about recognition and measurement of the financial instruments, usually we will go for the IFRS 9. And then if we are talking about the disclosure and the presentation, then we'll go to the IAS 32 in relation to that. But usually the IFRS 9, actually covered everything as well in relation to that. So this is a compound financial instrument, or if you want, a hybrid financial instrument. A compound financial instrument or a hybrid financial instrument is simply where an entity issues a convertible loan note, which means that the loan notes can be converted into an equal amount of shares in relation to that. The standard states that anytime an entity issues a compound financial instrument or a hybrid financial instrument, it must be splitted into its components, because it means that there is a debt component as well as an equity component in relation to that. So anytime we are dealing with financial instruments and we are dealing with compound financial instruments or convertible loan notes, always have it in your mind that we're going to be splitting it into the equity component as well as the debt component in relation to that. So let's look at how we look at this question. It's quite detailed. Let's break it down and then let's find out the salient points we need in order for us to solve our question in relation to that. But before I go to the question, let me say this, that there are 3 key steps that we follow in dealing with convertible loan notes when it comes to the initial recognition. The first step is for us to calculate the debt component. Now, how do we calculate the debt component? The debt component is calculated by discounting the cash flows on the convertible loan note without conversion rights. Let me take that again. The debt component is computed by discounting the cash flows on the loan note using the interest rate of similar bonds without conversion rights. This is very, very important. So once we get a debt component, we come to the step 2, and that is going to be the equity component. The equity component. How do we get the equity component? The equity component is simply going to be the proceeds from the issue of the loan note minus the debt component we had in step 1. So that is going to give us the equity component in relation to that. Then in case we have any issue cost, that is issue cost for the loan notes in relation to that, then the issue cost will be allocated on proportionate basis to the debt component and then the equity component that were obtained in step 1 and step 2 respectively in relation to that. So once we deduct the issue cost, the value that we have becomes the initial recognition for the debt component and then for the equity component in relation to that. Then on subsequent measurements, the debt component will be carried at the amortized cost, whilst the equity component will still be carried at the value at the initial recognition, and will be determined on how it should be treated at the date of conversion. So that at the date of conversion, if the bondholders convert, the treatment is going to be different. If the bondholders don't convert, the treatment is also going to be different. So when it comes to the treatment of convertible loan notes or hybrid financial instruments or compound financial instruments in accordance with IFRS 9 or IAS 32, these are the things that you need to understand in relation to that. So having had this knowledge, having understood the treatment of all of these items, let's now go to the question and let's see how the principle I just explained to you on the standards can be applied in the question in relation to that. So let's see. On 1st October, let's go to the requirements of the question as always. I love to go to the requirements all the time first so that we know what we're doing. In relation to the 6% convertible loan notes, calculate the finance cost to be shown in the statement of profit or loss and the extract from the statement of financial position for the year ended 30th September 2014, and comment on Lagos Services advice. So we are doing 3 things here, 3 things. Number 1, we are computing the finance cost that will be taken to the statement of profit or loss. Number 2, we need to extract the statement of financial position in relation to the financial instruments for the year ended 30th September 2014. And then number 3, we need to comment on Lagos Services advice in relation to that, meaning they they have made a statement or they have made a recommendation, and we have to comment on it in relation to that. Again, when reading the requirement, you must understand closely what you are supposed to do so that you don't do half and think you will get the whole marks. Because if you do the income statement without the statement of financial position and without commenting on the advice, then you won't get the whole 5 marks in relation to that. That is why it is very important for you to go through the requirement in that case. So let's see. So our year ended is 30th September 2014. Then we are greeted with a question saying that on 1st October 2013. Okay, so the year ended is 30th September 2014. It means the year started on 1st October 2013. So it's going to be a full year. Why is it important for you to also note this? You must note this so that you know how to compute the interest expenses that will be taken to the statement of profit or loss for the year ended under consideration. This is very critical. This is very critical because sometimes you know, but if you miss the year, you will get a wrong figure, and that means you have actually failed in answering the question in relation to that. So let's go D. On 1st October 2013, Bolgatanga Limited issued 10 million Ghana cedis, 6% convertible loan note on the following terms. Okay, so we are told that the company issued a 10 million 6% convertible loan note. So immediately we read that statement, 10 million Ghana cedis, 6% convertible loan note, you know that you are dealing with what? A hybrid financial instrument or a compound financial instrument. Then the 6% there is what is referred to as the coupon rate, okay, or the interest rate on the loan that we are going to be paying in relation to that. And then we see the nominal value of the loan note to be the 10 million Ghana cedis. So on the following term, the issue price was at par. Now, when we say it is at par, it means it is at nominal value. So you realize that I mentioned that already, that the nominal value of the loan note is 10 million Ghana cedis. No need for us to be thinking about it. It's stated there for us. The loan stock, now let me say this even before I continue. It's very important for you to understand because sometimes loans can be issued at a discount, meaning below the nominal value. What it means is that the proceeds coming in will be less than the 10 million. So assuming we were told that the issue price was at a discount of 10%, that means the proceeds will be 90% of the 10 million Ghana cedis. But in this case, we are told it was issued at par, hence the company had the total proceeds of 10 million Ghana cedis in relation to that. So that is one thing you must understand about that statement there. Because you know you need the proceeds in order for you to split the debt component and then the equity component. So let's go. The loan stock is convertible into the company's equity shares at the option of the stockholders 4 years after the date of its issue. Okay, so on the basis of 20 shares for each 100 Ghana cedis of loan stock. So this is the policy of the company. Very, very important. They have 4 years, so the life of the loan note is 4 years. But remember, the requirement of the question didn't say we should do the second year, we should do the third year or the fourth year. The requirement of the question is the first year because the loans are issued on 1st October 2013 and the year ended is 30th September 2014. So we are just looking at the first year. Okay, it's very important for you to note that. So we are told that the company or the stockholders, after the 4th year or on the date of conversion, they can convert it and get 20 shares for every $100 or 100 Ghana cedi loan stock, or they can redeem it at par, meaning they will get their money back in relation to that. Wow. Unfortunately, I have a very terrible current here, and my laptop is already going off. It means that the live stream can end any moment if my light doesn't get better. This is not good for me. Okay, so let's go. So if the live stream ends, it's because my laptop died. Okay, but let's go. It's showing I have about 25 minutes to go. Let's see if I can finish with this before it actually goes off. We have a terrible current today. I don't know, maybe because of the rain, like I mentioned earlier. So you could see that I'm in a dark, it's like the light is on, it's not on, that kind of thing. So let's go. So they can redeem it at par or convert it into 20 shares for each 100 Ghana cedi of loan stock. Legal Services had advised that, remember, the third aspect of the question was saying that we should comment on Legal Services advice. So it's very important for us to understand the advice they have so we can comment on it. Good. So let's see. Legal Services had advised that if Bolgatanga Limited had issued similar loan stock without the conversion rights, then it would have had to pay an interest coupon rate of 10% on the loan stock. This is because the terms of the conversion to equity shares are favorable. Remember, I told you that we will be interested in the interest rates on similar bonds without conversion rights. Remember, I told you that, right? So if the bonds were not having the conversion, the interest rate would have been the 10%. So we're going to be using this 10% for the discounting to get a debt component in relation to that. So that particular statement they've made, it's correct. We're going to be using it. Legal Services further advised that because it is almost certain that the loan stockholders will exercise their right to convert to equity shares, the loan stock has the substance of equity and can be included as such on the statement of financial position. This has the added advantage of improving or reducing the company's gearing, that is debt to equity, in comparison to what would be the case if the issue of straight loan notes. So this further advice of theirs is wrong. This is creative accounting. They are trying to, we will comment that that is not a treatment, because the fact that you are certain that the bondholders or the stockholders will convert does not warrant you to recognize. That's not what the standard says. The standard doesn't say we will recognize based on the certainty of the recognition. No, the standard states that for such convertible loan notes, we have to split it into the debt component and then the equity component. So they stating that the whole amount should be stated as equity on the face of the statement of financial position. It's wrong. It's not the right thing to be done, and that is against IAS 32 financial instrument disclosures and presentation. So it is against the standard, so that advice is wrong, cannot be implemented. The present value of $1 receivable at the end of each year based on discount rate of 6% and 10% can be given as follows. Unfortunately, I don't know what happened. ICA didn't include the discount rates, but even though they have stated that they are giving a discount rate for 6% and 10%, it's a trap the examiner has set for us. We are not interested in the 6%. It is the 10% we are interested in, because that is what we will use to do our discounting in relation to that. So let's begin the question. So remember the 3 steps we follow. We're going to find the debt component, the equity component in that case. Now, in this question, there was no issue cost. So we are not going to be having any issue cost. We just go straight. So the step 1 is to find the debt component. And the debt component is discounting the cash flows using the interest rate of similar bonds, which in this case is 10%. All right. So we have the year, the cash flow, the discount factor, and then the present value. Remember, the discount factor will be at 10%. So 1, 2, 3, 4. The cash flow to be brought will be the interest rate, okay, using the coupon rate, and that is at 6%. So you do 6% on the 10 million, and that will give you 600. So year 1, 600, year 2, 600, year 3, 600. Now year 4, there will be redemption. Remember, we are told that the loan notes will be redeemed at par. They will be redeemed at par. So it means that they will still get their 10,000 or their 10 million Ghana cedis. But in the 4th year, they will get their interest for the 4th year as well as the nominal value of the loan note. So that is going to be 10,600, okay? Which is the addition of the interest for that year and then the nominal. Now the discount factor, which was not given, but we could compute that 0.91, 0.83, 0.75, 0.68. Then we multiply them up respectively, and that will give us the present value in relation to that. So when we multiply, we're going to have 546, 498, 450, and then 7208. 7208. So we add it up, and that present value is what is going to give us the debt component. So the debt component, when we add this up, will be 82 or 87 rather. Zero two, 8702. So that is the debt component. Then the next question we ask ourselves is, how do we get an equity component? By lessening the the proceeds, right? We lessen this figure from the proceeds. So adding the 2 up should give us the 10,000. So the balancing figure here will become the equity component. And that is going to be 1298. So this is step 1 and step 2. There is no issue cost here. So in this question, there wasn't any issue cost. Like I mentioned, if there was an issue cost, we will allocate it between the debt and then the equity component using the values that has been obtained here in relation to that. Okay, so I'm going to be concluding around here today, unfortunately, because my devices, my laptop is already dying. Very bad current here today, so couldn't get my devices charged well. And so the stream could cut any moment from now. Really apologize for this. I wanted us to finish with this thing today because tomorrow I wanted to talk about another thing. But what's going to be happening here is that we're going to be continuing with it tomorrow in relation to that. So we will conclude here today, and God willing, tomorrow we will continue with the discussion and solve the final question. In that case, I'm going to be bringing some other questions as well up so that after solving these questions, we'll be able to look at them as well in relation to that. So thank you for joining the stream, and we are closing today as early as we are not supposed to have closed. So Patience, Andrew, Isaac, Saidu, Richard, Samuel, Grace, Ebenezer, Cledos, Moses, MCA, Richard, all of you guys, thank you for joining the stream, and I'll meet you tomorrow, God willing.